All righty. Good afternoon, everybody. Hope you're well wherever you are. Probably wherever you are, it's hot. Uh, I'm in the South and it is hot. And is anybody anywhere where it's 60 degrees or lower? Is anybody anywhere where there's 60 degrees or lower? That would be a tough one, wouldn't it? Um, Glad everybody's here today. Can you hear me okay? Can you type in the chat? Okay. That says I'm in California. It's not uh, 60. I think I said 104 in Austin. Oh my goodness. Yeah, Texas is known for some hot, hot summers. Well, let me ask a question just to give me a feel of where everybody's at least that's here today. What? Oh, my AC is 60. I like that. Yeah, isn't it amazing? Adolfo made a good point. It's like, how many notice that? It's like when you're going to a restaurant it could be 80 degrees outside, but it's like you want to carry a sweater inside the air conditioning. You could be freezing inside. You ever notice they have restaurants, some of them, it can get cold. I mean, inside, you're like, wait a second. Anyways, what do you, if I looked, so here's my question for you to start out. Uh, a way to get in your heads a little bit of what everybody's coming from different backgrounds, different experience levels. Let me just make sure I hit uh, record as it's recording. If we looked at your trades over the last 6 months to a year, and we looked at all of them, what would I see the most? Let's just say the last 6 months. If I looked at Adolfo's account or Jeremy, what one strategy would I see the most of? Credit spreads, calendars, long calls, directional something. Okay, Dan says credit spreads. Lab says far out of the money puts and also some double calendars. When you say far out of the money puts, buying or selling? Double calendars. Mark says credit spreads, some iron condors. Lab says selling. Jeremy covered plus and calls wheel basically. Okay. Kurt, earnings butterfly. Okay, around earnings, a lot of different stuff. Anybody else? I like to sell far out of the money puts so that it's safer if assigned. It's always tough for me, Lob, to get in my head the terms safer and selling out of the money puts. I know it's always hard for me to say, all right, safer, sell out of the money put. Okay, I didn't know those go together. But yes, I understand what you're saying. Jeremy credit spreads. Now, so when we look at a lot of the stuff, now the other question before I jump in here, and I'll go over a few things. I'm looking to get more consistent, maybe on once a week or once every 2 weeks, uh, doing a webinar. I think it'd be good to connect and go over stuff, see what everybody's thinking, going over. But my next question is, all right, I asked the one question, what one strategy would I see that you guys have been doing? But the next question, all right, how many if I looked, right? Corn future strangles, okay. How many if I looked at your account would I see continuity? In other words, credit spreads almost every week, calendars on a regular basis. How many is it? How many are once in a while, or how many of you would say, Dan, I'm pretty consistent with at least one strategy. I'm pretty consistent with one strategy. Anybody? Okay. Lob says, I sell when market pulls back, consistent with this. Okay. Mark says, I am consistent with credit spreads. And that's good. And where does everything, when you look at everything you said, correct me if I'm wrong, but any, if we look at any strategy that you guys can think of, at least my thought, you correct me if I'm wrong, is going to fall into kind of how I look at the options trading platform would be number one, we'll start with range bound. And range bound would be stuff that I'm going to put where my beginning position, we would call it deltas. Is anybody here not familiar with the term delta? Who would say, Dan, when I think of delta, I think of Delta Airlines or Delta Force. I don't under, all right, most of you understand delta. So range bound to me is that part, three parts of a portfolio. Range bound part of the portfolio would be trades put on because I think I have, for they're all positive theta. They're uh, the way you trade them have probabilities in the favor, but I'm taking it kind of a non-directional to a degree, right? And the main strategies in that area would be iron condor, some type of calendar, some type of butterfly, because you have balanced and you have broken wing butterflies, fly. Uh, and we probably do the most, if you said the most of what do we trade, calendars and butterflies, but you also trade quite a bit of double strategies, uh, double calendars, double diagonals, um, double long diagonals, uh, combo trades, which could be a butterfly on one side, calendar on the other. But the bottom line is you have maybe six or seven trades in the golf bag for range bound. Now, you might say, well, Dan, why don't you just trade one? How many think a golfer would do better if he only, how would a golfer do, and I don't know anything about golf, so excuse my analogy, if he just used one club for everything, right? Pick a club, he use it for everything. Would that be the most efficient way to do it? Yes or no? Yes or no? Somebody say no so I can continue. The question is, would a golfer with one club do as good as someone who uses all of it? No, of course not. Well, when you look at range bound and you hear Dan say, well, in their golf bag of trades for range bound, let's say they use eight. What if I told you there's really only two? They're easily can look at them. But for example, there's only two ways I look at the range bound trades. Trades where you're selling close to at the money, you're selling the most extrinsic value, that part of an option that decays the most. That's going to be calendars and butterflies. You can trade calendars when the vols are low, you think they're going up, trade butterflies when the vols high, coming down. So calendars and butterflies are a team. Why are they a team? You're both selling at the money. Does everybody get that? What I just said? Does everybody get that? So that's a pair in the range bound trades. Calendars and butterflies for the most part because of what you're selling. Is that understandable? Both of those strategies, you're selling the option with the most extrinsic value. Do you understand that? See, I'm used to in our community, I do this all the time. So it's a bad habit. If I ask a question and nobody gives an answer, I'm thinking either they're, if it's after lunch, they're resting, they don't understand, they're bored, they're distracted, So let me ask one more time. Does everybody understand at least a little bit of the why calendars and butterflies are similar because of the shorts? Can somebody say, yes, Dan, I understand what you're saying? Anybody? Good. All right, we have some live ones. I get it. Now, the other strategies for range bound in the golf bag, they're all related. Did you know double diagonal, double calendar, double long diagonal, iron condors, they're all related. They're first cousins. Does anybody know why? How are they related? Think about it. Calendar and butterflies are selling the at the money option generally, right? There's different ways to do these things, especially with butterflies. But what's the foundation of a double diagonal, double calendar, iron condor, any of those? It's a short strangle, selling an out of the money call or put. So basically, Dan, are you saying that all range bound trades, you're either selling the at the monies with the most extrinsic value or you're selling an out of the money call and put? That's correct, right? That's the range bound part of the portfolio. Now, there's another part of, now, the range bound, I'll just say this, the core of what we trade is maybe 11 days on the low end. On the high end, maybe 35. I mean, if vols were really to get high, I'd go further out, but 11 to 35. So you say, do you trade anything under 11 days? Absolutely. But this is the core stuff, right? The one thing I'll say about range bound trades, this would be the bigger size stuff. Under 11 days range bound, where you're getting 10 days, 4 days, 3 days, or 0 day, we would just go smaller size. Why would you go smaller size? Because as you get closer to expiration, your price risk goes up, right? The next part of the portfolio is here, long portfolio. We trade a lot in that, right? And it's really, most of it is a derivation of how many people trade the wheel or a covered right or a cash secured put or a buy right. How many of you have traded that type of strategy? Right? So we do it in an options portfolio, but we're going to do it different. I have done a course on the all options wheel, right? And it's all the same principle, right? If you do a covered right, we do long diagonals, we'll call them. It's a poor man's covered right. So all we're saying is instead of buying very expensive stock, we'll buy an option instead of the stock somewhere. And then we'll sell the same call you would sell in a covered right against it. Does that make sense? So we're putting up dramatically less capital and we're getting dramatically better yields. Does that make sense? It's just simply substituting a long option instead of long stock. Now, am I saying covered rights and cash secured puts are bad? Of course not. I'm just, again, what we look at is the most important thing is yield, right? Um, Now, I'm going to get to puts in a second. Um, Here's the difference. Lob says, why not just sell puts instead of long diagonals? Can anybody answer that? Can anybody answer that? If you sell puts, let's just take selling puts versus covered right. Which does better? Which does better if a stock has a good run up? Selling puts out of the money or covered right if you're selling and out of the money? And this may be a little, I'll just give a quick answer on this because this could be quite a discussion. But the point is, Generally, covered writes are going to be longer delta, more delta. They'll do better if it goes up. Cash secured puts are wonderful. The only lament with cash secured puts are what? Oh, geez. I sold a put for a buck and a half. The stock went up $42. Oh, my goodness. Oh, my goodness. If I would have been long the stock or had a covered right, I would have made much more, right? So Dan, what are you saying? You can't have your cake and eat it too. Cash secure or selling a put is, easier, but easier doesn't make it better, right? There's no better in any of these. But anyways, so in the long portfolio, instead of a covered right, we do long diagonals, but we also do them differently. We will do them on the call side if it's going up. But let me ask you, even good stocks like Microsoft, when they're up 5, 6, 7 days in a row, do any of your good stocks that all of you have in your portfolio, do they ever go down? Have they ever gone down the last 3 years? Any of your good stocks? Have they ever had a down day? Well, of course. You say, Dan, that's silly. Of course. Right? So the point is, we'll go both ways. Call and put diagonal. And you have enough room between the long and the short that if it did go against you, you're rolling it and you have a really good plan. Right? But anyways, so in the long portfolio, long diagonals are a big thing. But the other thing are in the long portfolio, even though conceivably we could talk about it here, put credit spreads, right? Put credit spreads an alternative to selling a cash secured put. Why? Again, if I sell a cash secured put in SPY, right? How much money, no matter what I sell that put for in SPY, if I sell a cash secured put, let's say in a retirement account, how much capital with SPY at $786 do I have to put up? Anybody? Anybody? If I sell a put for $2 in SPY, cash secured put, so I'm willing to buy the stock if I get assigned, how much capital do I have to put up for that? Well, I'm not talking about a portfolio margin but like in a retirement account. Isn't in a retirement account they're going to make you put up about $76,000? $76,000 to sell a $3 put. Well, my point is, why in the world, if you're selling a put for $4, would you not go in there and buy a put for 60 cents or 80 cents against it? It behooves me. Is that a word? It behooves me. Is that a word? I don't know. But so long diagonals, put credit spreads. I mean, obviously in the long portfolio, you could buy leaps, but that's kind of what we do the most. And then spec would be, you know, 0 day directional stuff, right? It could be anything involved with earnings I would put in spec, right? Do you agree? Can you justify calling anything around earnings range? It's a range bound trade. No, I throw anything to do with earnings in spec. Spec would be ratio back spreads, reverse iron condors, anything where you're betting on some movement, uh, trades on for the expected move, like a butterfly for that. So you have three parts of the portfolio and you trade accordingly. Now, does it mean you have to trade all three parts of the portfolio? No. I have a lot of students who will trade just range bound. Some will trade both of these, right? Um, and then, I students will trade 0 day, 1 day, 2 day. But I mean, the core of the range bound is this. Then you have long portfolio and spec. Um, Someone said, what's the DTE difference between strikes and the long diagonal? Are they far out like 1 year one? It depends, but a lot of times we might buy something 70, 60 days out, sell something 10 days out or less. And if it goes against you, you have plenty of room to roll the shorts uh, until it reverses. That's the idea. Another question says, better return on investment compared to just plain cash. Yeah, and it's just, I mean, that's why I think the wheel straight, I think an all options wheel is a much better way to skin the cat. Anyways, so that's kind of the big picture portfolio. Now let's just get into. I just want to get into some strategies. We can always uh, come back to different things. Um, Someone says, "Do you offer one-on-one coaching?" Not, I don't really do that anymore as much. Uh, it's more. We have a much, I think, uh, better, different model now. We just have a subscription model, with for relatively cheap. You can come any month in and you get everything. So it's much better for the student. One-on-one, uh, yeah, it just changed the way we did things here. Um, Mark says, generally, what VIX range do you consider low VIX? Well, part of this was to do with, I mean, would everybody agree 14, 15, where we're at today, and 16 would be low end range? Do you agree? Low VIX would be that if you broke up over the last year the general numbers in VIX, this would be the low end where we're at today. Everybody agree? 15. Now, let's review the last 3 weeks in the market and let's go over. Can everybody see this SPX? Yeah, recording will be available and you'll be able to uh, look at that. If you have any questions, you could let me know. But so, when we look at what to do, right? If you look at kind of this outline we were talking about, this is important. We talked to the three parts of a portfolio, but how do you decide whether to trade each day, what strategy to trade, and your size? And we do this every day. Now I'm simplifying it because just for a little half-hour discussion, it's hard. But so what every day do we do in our community? We have a couple hours of live classes, but what do we do every day to determine do we play or not? Right? We look at price action. And again, I'm giving you the quick and easy version, right? Price, vol, and news. Based on an analysis of those things every day, and it's pretty easy. I mean, it's not like you have to have a town meeting to determine it, right? But until you get used to it. But if you look at it, I'm generally price. I'll give you the quick and easy. Are we? Yeah. And again, Lob, I'll just say this. We're not an alert service. We've been doing, uh, what I try to do is teach people to become craftsmen, do it themselves. So we do 2 hours of uh, live sessions a day. The whole thing is how to put on trades. We put on a bunch of live trades during a week, but we're teaching you how to do it. Does that make sense? All the trades are available uh, for you to see, but it's not an alert service. In other words, are we making you put a little effort in? Lob, what do you think? To become a craftsman, do you have to put a little elbow grease and understand it? Yes or no? What's the expression? You can teach a man to fish or you can fish for him. So this is teaching you. All the trades are there, all the trades you'll be able to see, but we're teaching you to do it. All right. So if you look at the market, um, um, but if you look at this, um, if you look at this, when we're looking at price, what do I look at? I'm looking at, here's the last 3 weeks. Is everybody familiar? How many have been alive the last 3 weeks? Yes or no? I'll answer one more question from Lob, and then I'm just going to go through and I'll answer questions at the end. But this is a great question from Lob. I got it, but do I get good trades to put during those sessions? All these trades are good, but here's the thing. If I give Lob a good airplane, the best airplane available, right? It's the best airplane ever made, right? Give him the airplane and I stick him in the captain's seat. Is anything going to happen? Right? We give the trades, but the idea is that within 3, 4 months, you're able to do it, right? You're driving it from day one. We're telling you what we're doing. We're showing you everything. Um, we think they're good trades, but what does that mean? Good trades, right? Good trades could mean, are they all going to work out? Nobody knows, right? But we think we have edge with them. But what makes good trades is also not just the timing of it, but how you manage it. All right. I'll wait till the end for any more questions, and then we'll go from there. So as I look at the last 3 weeks, what do we see the last 3 weeks, right? So we're looking at price first, and then I'll go into some trade examples. So if you look at here's 3 weeks ago, right? Remember that? July 30th to Aug 4, we had 4 days up of 400 points. One of the biggest moves we've seen in a while, right? That's a huge, like 4 standard deviation move. And then from August 5th to August 21, we've had 13 days and we've been consolidating. We've been in a tight range for 13 days, right? What do you mean a tight range? Low amounts between the low and the high. That's why this average true range is low. That measures the distance between the high and the low. So we've been consolidating. I mean, net, the last 13 days, we've been down about 50 points in the SPX. That's it, right? These were the 4 days. So when I'm making a decision, we generally are putting trades on the same capital every week. So you have a turnover of every week. And so if you're putting on a 20-day trade, a 30-day trade, a 10-day trade, we're looking to be in about 30% of the duration. So we're turning over the inventory each week. That's the goal overall. But when I'm looking at price, yes, I'm aware of this. This 400-point move up puts us near the highs. But I'm also aware, if I'm putting on a trade that I'm going to keep for the next week, I'm giving more weight to the last 5 to 8 trading days. So am I giving some weight to this? Yes, but a little more weight to the last 7 or 8 days. So I look at price. Are we basically, during this 4 days up, we were backing off of range bound trades. You say, why? We weren't range bound. Now we've been more range bound, but we've been putting on more range bound, relatively uh, uh, delta neutral, just trying to maybe have a little more room on the downside. So that's the big picture on price. There's other things. Then we'll look at volatility and see where's the vol trading at. Overall, if VIX is 14, 15, 16, around there, overall, we might favor strategies that would benefit if volatility went up, like calendars. Uh, and then if vol were a little higher, um, we might put on trades that would benefit if volatility goes down, iron condors or butterflies. Even though I'm going to show you today a, can't, the question is, can you do uh, short Vega trades like credit spreads, butterflies, and iron condors in a low vol environment? Yes or no? Can you do in a 14, 15 delta volatility environment? Can you do short Vega trades? Yes or no? What do you think? Strategies that benefit if volatility go down? The answer is yes. Of course you can, right? Again, it's how you trade it. Yes, if you're short delta against your short Vega, they're fine. And I'll show you, I'll just give you one example today. Um, Um, you know, I've seen many, many short Vega trades do great in a low vol environment. It just, I think, how you set them up. And I'll show you one. So, so that's the uh, price action. So as I'm looking at trades today, I mean, it's Friday. I don't put a lot on Friday. Could put some stuff on Friday. But as I look at the way the price action is in the way volatility, when we start out Monday, if you said to me, answer three questions, whether I would trade. Oh, I forgot one thing. News. Trade you're going to be in for a week. Yeah, you look at news. So I'd look at next week. Is it going to be a big news week? Is there any big news coming out next week? Is there any big earnings next week? I think the big earnings is what? What's the big earnings coming out next week that we should be aware of that could change the course of life next week? I'm joking. Nvidia, right, Bob? And so with all that, would I trade next week? Yeah, of course. Range bound. Would I trade normal size? It depends on the trade, but I might trade pretty close. It just is Nvidia a concern next week? Yeah, because Nvidia is such a big weight, right? It can affect things. So when Nvidia's earnings is coming out, as far as timing of trades, you could wait till the day after Nvidia to see how it is. So you're kind of navigating through this thing. So I'd be looking at a little bit of, so if I'm looking at trades, what type of trades? Um, let me finish this and then I'll answer some of the questions after. But so I'm just throwing in some trades that, three trades, right, that have in a low vol environment uh, can work pretty good. Uh, and these are three trades. You say, what made you think of these three trades? These are three trades in the last 2 weeks that overall have done well, right? I'm just thinking of as recent as you can get. And one will surprise you. But here's a basic calendar, right? So here's a basic calendar trade, how we might do it a little bit under the market. If we're at 76, 74, you might run it a little bit under the market, 20 some points. Generally, we would do calendars on days the market's up and volatilities are down like today. You run it a little bit under the market, maybe 25 points because you can still get relatively delta neutral. And that's it. A lot of times we'll do four wide between the long and the short. This one is $6.70. And calendars, we usually do them 2 to 3 weeks out. But again, here's the most crucial thing is how do you think what separates really good calendar traders from the rest of the group? What do you think what separates really good butterfly people from the rest of the group? What separates really good iron condor traders from the rest of the group? There's an answer. What do you think it is? What do you think it is? What do you think it is? It's, well, obviously you have to understand it, but do you think if somebody yeah, I mean, assuming, I'm assuming, in other words, when we teach or you can look online at places, we'll give the full plan, when to do a calendar, how to do it, how to set it up, what's your profit target and max loss, when would you adjust, how do you adjust, everything. But does that mean if Mark or Lob have done 10 calendars in their life and someone's done 150 and is sticking with the guidelines, who do you think it would be better? Who's usually a better pilot? Someone who's flown 10 hours or 1,000 hours? What do you think? In other words, is this a craft, right? I traded it at the CBOE in Chicago before for about 20 years, 23 years before I left the pits and trading retail. I've been in the options arena for about 40 years, since 1982. How many years is that? What year are we today? We're 26. What's 26 and 18? 44. Wow, that makes me old, doesn't it? Uh, been doing this for 44 years. Uh, that's old, right? I'm 60, what am I, 67? That's a long time. But the point is, this is a craft, right? You can give people, and you might say, hey, Dan, why, when you just talked about calendar, did you give you exactly how you guys do it? And you've been working on this for years and assuming it's a decent plant. Because you know what I noticed after I traded for 22 years before I came into the retail arena 20 years ago. I've been teaching over 20 years now. Let me tell you something you probably never figured out. How many would agree with me? Options trading is tough. Do you agree? So if I tell Mark how to do a calendar, I want to help any way I can because I know it's tough. I know the probabilities are 80% in my opinion by telling someone something. Um, Mark won't stick with something, right? It's not nothing against Mark, but just what I've noticed over the years. I used to do seminars a ton for the Chicago Board of Options Exchange when I traded there. And I remember doing seminars for 30, 40 people. And I would say, look, we talked about a calendar for an hour. I gave you all the guidelines and everything. If you, over the next 2 months, do 4 or 5 calendars, just put them on a piece of toilet paper and mail it to me, put it on a spreadsheet, anything. I'll trust you. Send it to me. I'll send you Portillo Italian beef. That's a place in Chicago. Very few. In other words, very few stick with anything, right? Have you noticed that in the retail arena? Anyway, I'm just telling you from someone who's at least been around a while. Not that it means, but observations. Any questions on calendars? Now, again, I'm not going to get into, but I'm just saying calendars have worked well. Uh, but a lot of it is, remember what I said? We put them on days the market's up. We put them on when vols are in the low end of the range, kind of. We put them on a little bit under the market, right? Um, and then you have your risk management is basically you have these things called expiration break evens, right? You have a plan. If we start going outside this, you have to do something, take it off and do something or adjust it. This is kind of your positive area. But calendars are a very good trade. They're probably one of the more effective trades we've done in the last 20 years in the community. Calendars, uh, most of the time I'll do them different. You can do different durations. You might have on, if you put $5,000 of calendars, you might put 80% 3 weeks out, uh, 20% 2 weeks out, or you might do 20% 3 days out calendar, and then you might put some further out. Does anybody do calendars on a regular basis? Anybody do calendars on a double calendars? Yeah, double calendars. Now, let me just say this. If we're doing trades 15 days and out, I found single calendars are better, right? And maybe in the future ones we'll go into them are better. I'd rather be in single calendars. If you said to me, you start getting 11 days or 12 days or less, I'd rather be in some type of double calendar, double diagonal or something. Can anybody guess why? A double calendar, Tim, is just, if you look here, would be this. So if you look at this, Tim, calendars have worked very well all year, have worked very well. Again, Alan, a lot of it is when you put them on, right? Using some of the things we talked about today. But again, Alan said something about diagonals. Do diagonals have anything to do with calendars? Is diagonals and calendars a different strategy, right? Diagonals are more, again, if you're looking at range bound trades, diagonals are going to be more expensive and usually you'll have more delta, more directional. Calendars will be less delta if you're using it range bound. So again, remember where did we say long diagonals, like a poor man's covered right would be in the long portfolio? You can do a type of a diagonal calendar, but they're more deltas. Uh, and again, I don't know exactly what a land means with or how he does a diagonal or something. Um, yeah. But here's a double calendar. A double calendar is just saying anything with the word double I use in certain situations. When there's 10 to 12 days to expiration, that's when your price risk goes up. You have a Greek called gamma. You have more price risk. So in those situations where we're 10, 11, 12 days or less, I would use a double structure because you get wider break evens. That's it. 15 days and out, I'd rather use a single calendar. So if we're at 76.70, on the upside, I put a calendar in the calls at 77.50. Let's go up 80 points. On the downside, let's go down 70 points, 7,600. So we're here. If I'm doing something shorter term, I'd rather be in a double. Why? It gives you a little bit more break evens. That's why. But single calendars will give you more theta. So it's just application of it, right? Doubles are great. I do them more closer to expiration or shorter term. If you start getting 15 days out and more, I just find single calendars work better, right? Let me just go a few more here. Here's a double diagonal. I'm going to just give you two more strategies. Double diagonal is more popular in our community than double calendars, right? Let me explain why. You might say, Dan, what's a double diagonal? It's a first cousin of a double calendar. In other words, I use the same shorts, 77, 70, same shorts in a double calendar, double diagonal, whatever, short strangle, selling the out of the money call and put. The only difference is a double calendar is going to buy more extrinsic value. A double diagonal, the longs are going to be further out of the money. So you'll get quicker theta. Why? You're buying less extrinsic value. So in a double diagonal, I'm buying my longs 10 points further out of the money. 75, 70. And that's been a really good strategy. That's a double diagonal. And then, yeah, the diagonal. You're selling the double diagonal. That's what this is the same family as iron condors and double calendars. They both are selling the out of the money call and put. The difference is where do you place the longs? And a double calendar, the longs are the same as the shorts. And a double diagonal, our longs are 10 points further out of the money. So but generally, I find they get quicker theta. You get out of the trade quicker than a double calendar because you're buying less extrinsic value in your longs than a than this. Um, generally in these double strategies, uh, you know, from experience, somewhere between a 30 and 35 delta for our shorts. And then the last thing, and this has been one that's worked well over the last couple weeks um, has been we call it a Sherman tank. It's simply a 7065 call butterfly. Uh, where are we at here? 7675. Let me just tweak this a little bit. Gives you a little bit of short delta, your positive theta. So you get more room, a little bit more room to the downside. It's a slight broken wing butterfly, right? So what it means broken wing is, so let's say we're at 76, 76. I might go a little bit above the market, 76.90. Okay, that's the short in the calls. Then I'm going to go to the downside, 76.20. So I'm going 70 points below. And then I'm going about 65 points to the upside, 77.55. So we would call this the very slightly broken wing butterfly. From the short to the long call in the money call is 70. From the short to the out of the money call is 65. So when you have different widths from the short to either of the longs, you just call it broken wing or unbalanced, whatever. So generally, so when we're starting to get a little bit of down action, um, maybe the vols decreasing a little bit, uh, this is a good butterfly. Uh, and we had one of our veterans in the community and meet put a couple of these on in the last 2 weeks, and they've done really well. Better than actually. What's funny is in the low vol environment, that's the thing. A strategy that benefits if volatility goes down, butterfly, um, has done better than some of the long Vegas strategies in the last week or two. Um, All right, I'm going to run here pretty quick. I should be back next week or the week after. If you have questions, you can send them to me, and I'll try to keep them and answer them at the next session. If you have any questions you want me to answer or go over, I'd be happy. I'll get a few here. Jennifer says, and I'm happy to answer some questions here. Jennifer says, before you go, can you explain what courses and memberships you offer? We just have only one thing you can sign up for us, right? Just we have uh, a monthly subscription, and usually we give if you're signing up, you can get a discount. So it's like around 130 a month, and you can cancel anytime. We don't make it. We don't even let people sign up for more than a month. It's just a month, right? That's it. And 130, and that's everything. It's basically 2 hours of live Monday through Thursday at like 9:45 and 2 Eastern, and it's recorded. We're on doing it. We're looking exactly what we talked about today, looking for trades. We're teaching and trading. So an alert service gives you the magical thing, and there is none, right? What we do is, as a community, we figure out together what to do. So you have teaching. All our online courses are included in it. Anything we do is included in it. We have a Discord channel where all the live trades are. So it's really it's like a working hospital, right? You're getting the teaching, but you're getting the trades. The goal is that for 3, 4 months, you're looking at the Discord, but then you're able to fish for yourself, right? If you just send me an email, you can send one to Dan at SheridanRiskManagement.com or support at SheridanRiskManagement.com, and we could get you a coupon for a month. Or, I mean, it would stay at that price, but we'll get you a coupon. So it'd be somewhere in the 130-ish or so. And again, the goal is to teach you to do the craft, right? We're alert service. We're just trying to teach you the craft to do it yourself. Period. I mean, and we've been doing it for I've been doing it for quite a while. This is a different model, a different way of uh, doing things, subscription model, and generally it's 2 hours a day. So, um, and that's that. Um, yeah, yeah, and you could trade similar trades, but it's teaching you. Our goal is to teach you to do the craft. Period. um, when trading multi-leg options, is it possible that not all legs get filled at the same time? Well, we do things generally, if I enter a calendar, a double diagonal or butterfly, we're doing it as one trade. So we're not legging into these things. Does that make sense? We're putting it on as a trade, generally in SPX, but we trade quite a bit of stocks. If you're in a liquid stock like Nvidia or something, but mostly in SPX, but we're putting it on as a spread. We're not entering them one leg at a time or something. All right. Any other questions? Uh, oh, someone said for 14 days to expiration, pre-earnings, long vol trades. Would you prefer double calendars or single calendars? Still generally single, but if I'm doing anything around earnings, especially before, I mean, that's a whole different discussion. Um, yeah, that would take me a while to get in because that brings a lot of different issues, but generally single. Taking NVIDIA trade today, what would you recommend? How should people act? So you're saying, what would I do in NVIDIA today? And again, just to be clear, we're not, we're doing very methodical kind of, a lot in SPX trades, but we'll trade other, if it's something liquid like Nvidia, we'll look at that, but if you look at, I'll take a quick look here. If you look at Nvidia, you know, do you have an opinion if you're looking at this? I mean, the way I would look at this is right now, if I had uh, Kurt says 10% good profit target generally in what? We have a different profit target for spec trades, a different profit target for diagonals or poor man's covered rights or that type of trade, different profit target for earning stuff. But for range bound trades, it could be 10 to 15% if you're in maybe 10 to 12 to 35 day. If you're in 0 to 5 day calendars or butterflies, it might be 30% or 40% different. So considering earnings next week, the first thing I would be looking at maybe past earnings, does NVIDIA, this is where history would come in, does NVIDIA have a history of rallying into earnings? So here you have it's been down a little bit over the last 4 or 5 days. Does NVIDIA have a history of rallying into earnings? So, you could play it, so right now you have two batches. Do you agree? Uh, Earnings are next week. Do you get, we're at basically near the lows of the day today, 214. We've been as high as 227 uh, earlier in the week or whatever. So again, maybe you play a call vertical or something up, and then we could see going through earnings, we'd have to look at it. We usually look at earnings stuff maybe the day before or something. But again, when we're looking at NVIDIA for earnings, what part of the portfolio, let's see if you were listening. What part of the portfolio, as we're looking at NVIDIA for something to do for earnings, would it go in A, range bound, B, spec, C, long portfolio? Spec, spec. Earnings are a binary event. It's a binary event. So when it comes to spec, we trade much smaller than range bound. We'll put more capital in range bound, second batch of cap, smaller into long portfolio, and then spec the smallest, right? You know what? I better cut it off. I have something else to to do. But I will uh, please send me questions. I'd be happy to answer them next time we meet. Hope you had a hope you got a few ideas on something. Have a nice day and a nice weekend, everybody, and we'll see you next time.